Welcome everyone, I'm Lucas DePaulbay. Today we're diving into the rapidly evolving world of AI investing opportunities beyond the expected. Joining me today are portfolio managers of the Fidelity Global Future Leaders strategy, James Abella and Maroon Yunus, together with Terence Tsai, who joins us from Hong Kong and is the technology sector lead and analyst. Together, we'll get under the hood of our AI investment framework as our experts share how they are leveraging Fidelity's research platform to uncover new and diverse opportunities. Welcome, gentlemen. James, let's start with yourself. And if we think about the broader global investing landscape, particularly as it relates to AI and the large cap giants in that part of the market, what are some of the key observations you have?
I think the AI trend is here to stay. Technology has been a huge trend for 20 or 30 years. It's going to be a trend for a number of decades. But the AI thematic today is going to transform market structures. It'll transform industries. It'll allow for higher productivity. It'll lead to innovation. And it's also the speed of innovation is also going to change. This it is called the Industrial Revolution or the next Industrial Revolution, and that is what it will be. So the opportunities in that context are big, they are broad and they are large, so the opportunity set is quite significant. But the focus of the headlines have been mainly in the mega caps in the US, which have dominated the headlines, but there are opportunities below that. So that's what we do look at in mids and smalls globally. There is energy, there is software, there are enablers, facilitators, semiconductors. So there's a number of opportunities that are available in that entire universe. So it is exciting and we do think it is here to stay.
So Maroon, it is an exciting part of the market and an evolving part of the market. But when you think about sort of that AI theme and those large mega cap tech names, what are some of the challenges you think in terms of, particularly that a lot of those stocks have done really well? So what are some of the challenges you think about?
Yes, there's a few. I mean, the first will be valuations, right? These predominantly US names, mega cap names, are trading at valuation levels in excess of their long-term history. If you look at a 20-year history, they're trading at levels in excess of that as a group. Now, why that's important is valuation levels give you an insight into what the market is pricing in terms of its expectations for those companies. So the bar is very high. And, it's one thing to be able to grow quite rapidly when you're small. But as you get larger and larger, maintaining that same percentage growth rate gets a lot harder. And you've got some of these companies now that have got market valuation levels larger than developed economies. I mean, there's a handful of companies in the US that have market valuations bigger than the entire Australian economy. So it's staggering that these companies of this size need to maintain such an exceptional growth rate going forward to keep investors in the broader market happy. So that's the first thing. The second thing I would say is the nature of their business model is changing. One of the factors that investors loved about these companies historically is that they were relatively capital light. You could grow without investing a huge amount of money. If you think about Microsoft, for example, once you created a version of Windows, you could just sell it and sell it and sell it for relatively low cost, incremental low cost. Google could just add users to its platform without a huge amount of additional costs. So it was quite capital light. You didn't need to invest a lot of money to get larger. AI is now a game that is quite capital intensive. You need to buy chips, which are very expensive. You need a huge amount of storage or cloud, whether that's your own data centers or you rent that out from third parties. You need complex LLMs, models, etc. So it's quite capital intensive. And if you just took 4 companies, for example, Amazon, Google, Meta, and Microsoft, and you looked at their CapEx profile 10 years ago, collectively, those companies did about $23 billion in CapEx back in 2014. That number today is more like 240 billion. So they've actually grown their CapEx profile 10x in 10 years, which is quite a large growth rate. So they now need to earn the same rates of return or very high rates of return on a much larger invested capital base, which again makes it very hard. The other part I would say is there's an increasing amount of circularity that's building into these companies with OpenAI seemingly sort of at the middle of this web. So you've got some of these circular transactions, like OpenAI is pledging to buy a huge amount of chips of NVIDIA for the next decade, and in return, NVIDIA is investing in OpenAI. Similarly, OpenAI is pledging to rent a huge amount of cloud capacity from Oracle, and in return, Oracle is going to invest in OpenAI. OpenAI has a similar relationship with AMD, where they're going to buy a huge amount of chips from AMD going forward. And so now these companies are becoming tied to one another in a way that's deeper than just the pure sort of customer relationship way. And that sort of has some similarities or some shades to what we saw during the dot-com bubble. Back then, we had this concept known as vendor financing. So if you were a cable company and you wanted to build out your cable network, you could go to someone like a Nokia or Alcatel-Lucent, and then you could get vendor financing, where they would lend you the money that you would then use to buy product off them. And so those companies became intertwined. We're sort of seeing elements of that, coming in more recently, like literally in the last 2 or 3 months. And so that, I think, is, it's not necessarily bad, but it's increasing the level of systemic risk, because you can have a scenario where if one domino falls, it has a cascading impact on a whole bunch of other companies, and very quickly you can have contagion feeding throughout the system there. So the risks are becoming a little bit more elevated.
So Terence, if we think about this part of the market, which is very dynamic and complex to some of the Maroon's points that he sort of outlined there. And so we think from an investment perspective, you need to have some kind of framework. And you've, along with the team, developed a broader AI framework in terms of how we look at these companies in this part of the market. Can you take us through some of those key elements of that framework and some of the thinking in the development?
Sure. So technology is really a lot about looking forward, but you actually learn a lot looking at the past. So history doesn't always repeat, but it does rhyme. Uh, every 10 to 20 years, you see a big technology shift or an era change. And we've seen it in the mainframe era, the 50s, 60s, the PC era, and then we moved to the mobile era, the cloud era, and now probably very early innings in the Gen AI era. The commonality for companies that participate in these technology shifts throughout these eras, you can roughly group them into one of 3 buckets. The first bucket is the enablers. These are the pick and shovel plays. They provide the hardware, the infrastructure that's required for the entire technology to run on. In the middle, you have the networks, the companies that diffuse and cascade these technologies to the masses and improve the adoption of that particular technology. And finally, you have the innovators. These are your creative geniuses that think of use cases and applications for each technology era. So in the current AI era, the enablers are quite obvious, as James has alluded. These are your mega tech companies like your NVIDIA, Broadcom, maybe TSMC, that are perceived winners of this Gen AI era in the early innings. What is less clear is the networks and the innovators. If history is any guide, the winners of the past eras are not guaranteed a spot in the next generation of the next technology era. And that's where it gets really exciting for stock pickers to look for opportunities in those space. And in slide 2, if you look at how the value is extracted throughout each era, there is a timing to it. In the early innings, the enablers are the ones that extract the most value, because think of it as laying down the train tracks, the railway tracks. You have to lay the infrastructure down before the town and the economy is built around the train tracks. And so these are the ones that outperform the market early on. And we're probably seeing it right now with NVIDIA and AMD and TSMC. But as the technology progresses, the networks will start to extract more value and gain more of that bargaining power, because you need them to diffuse the technology to the masses, to enterprises, and to consumers. And finally, you need the innovators to be able to really make the most profit, such that it can feed the money or the value down the chain to the networks and the enablers. You need each level and each layer of these of the stack to be profitable for the entire era and the generation of technology to work. So that's the high level framework on how we view this.
And if you take that framework that you sort of described, this concept of enablers, networks, and innovators, and there are, I guess, a range of sub-themes that sit underneath those three broad categories. Can you give some colour to some of those sub-themes, potentially maybe the enabler category?
Yeah. So for the enablers right now, it's all about compute, right? AI isn't new. It's been around for a long time. But the reason it's become impressive is because they threw more compute at the problem. And so compute is driven a lot in the headlines by NVIDIA because they're able to produce the most powerful and performant GPUs, graphic processing units out there. And these are extremely costly, like Maroon said. They cost $40,000-$50,000 a chip. In technology, the game is always about bringing down the cost, because when you get costs down, adoption goes up. And as these chips get more and more expensive, the cost of doing business is getting higher. And that kind of stands in the way of AI being more widely adopted. So one of the themes that's come up is the theme around advanced packaging. Packaging historically has been a very low margin, labor intensive business. It's the lowest margin business across the semiconductor ecosystem. But because Moore's law is slowing, Moore's law has been the tailwind for technology over the last 40, 50 years, because what it means is you get twice the performance for the same cost. That's why our iPhones are 100,000 times faster than the rocket that sent Neil Armstrong to the moon. But it doesn't cost, we don't have to spend a defense budget to pay for that iPhone. And that's because of Moore's law. But Moore's law is slowing. Moore's law is not as effective in bringing the cost down. It can still push performance, but the cost is not coming down. So enter advanced packaging. Advanced packaging helps you get better bang for your buck. It's another alternative, it's another method to get performance at a reasonable cost. And so there are companies that have been ignored or sectors that have been ignored that are seeing the value shift to them as we look for higher compute at a reasonable cost.
So Maroon, if you think about what Terence just sort of described there, there's a lot of moving parts, and being a portfolio manager, you're trying to sort of distill a lot of information. So how are you leveraging this AI framework that we use at Fidelity in terms of identifying those sort of opportunities, and maybe touch on some examples?
Yeah, so Terence made some wonderful points there. I think the first is that sequential nature of the timing, where it's the enablers followed, by the networks, followed by the innovators. And so right now, because we are in the early innings of the broader adoption of AI, the enablers, they're having sort of their moment. So there's a couple of companies in our portfolio right now that sort of play into that space. And so Terence mentioned advanced packaging. One of those companies that we own is called BE Semiconductor, which has it involves a technique called hybrid bonding. Used to be quite costly to do, but now, as Terence mentioned, with Moore's law slowing down, that's becoming a cost-effective solution, and so we're seeing increased adoption of that. So BE Semiconductor, European name, plays right into that enabler space. Another one is ST Microelectronics, which is predominantly, it's a JV between Italian and French. But they provide analog chips that get used in industrial end markets, which is predominantly autos. Very power efficient way of doing it. So it solves a lot of the cost issues that sort of Terence alluded to. So there's a couple, another one would be NRG Energy, which is a US Texas-based utility. We're seeing a huge build out of data center capacity across the US, particularly with that Stargate project. Some of that is going into Texas. You've got a huge amount of land in Texas and it's relatively flat, so it makes it ideal for data center capacity. And those data centers are enormously power hungry. So you need utilities to provide more and more power. In addition to powering households, you need more and more power just to power these data centers that are going to come online. over the next 5-10 years. So there's a couple of examples there. Historically, we've also owned a couple of other companies. One was Arista, for example. They make network switches. So if you think about a cloud or a network and you have different devices that sort of talk to each other and transfer information from one to another, there's an enabler there called a network switch. And so Arista, along with Cisco, the two market leaders, but Arista has historically been the leader in the hyperscale segment. So their two largest customers are Microsoft and Facebook, Meta. So they're leveraged into that. We unfortunately had to sell that because it was too large for us and a success story for us. Another company we've owned in the past is called Vertiv. They do liquid cooling. So if you sort of think about data centers, they create a huge amount of heat. Just think about your normal PC creates quite a bit of heat when you use it. Your phone, if you use it for an extended period of time, it can get quite hot. So imagine an entire shed of just computer equipment working 24/7. Generates a lot of heat. So you need to come up with innovative ways of cooling these things down, cost-efficient ways of cooling things down. Vertiv was a company involved in liquid cooling, so it was sort of selling into that space. So we're seeing a lot in that early enabler phase. The innovators will likely come further down the road, as Terence said, but they extract quite a bit of value, but they sort of they build on top of everything that comes before them. So we're keeping a keen eye on the innovators that come through over time, but right now we're definitely sort of playing a lot in that enabler space.
Okay, great, thanks, Varun. Terence, is any other observations from your side?
I think the one of it is just a lot of the innovators have not really come to light, and that's normal because a lot of the innovating company were founded after the dot-com bubble burst. Who knew that we used to have to get on the internet at a specific physical spot in our homes. So who knew that you could get into a stranger's car and have them take you to your destination, or have food delivered to your homes, or check out other people's vacation on the internet. I think those creative use cases may not have come to light yet, and that's why it's important for someone like us to have our research team on the ground and to locate and to discover these innovative companies who start off as small and mid-cap companies and eventually become winner take all in the Gen AI era.
So Terence, maybe if we stay with you, and one of the interesting things in recent years is that a lot of the discussion around AI has been very US centric. A lot of advisors may be familiar with the Mag 7 stocks like Nvidia and so forth, which really got the headlines. But outside of the US, Asia's an interesting part of the market in relation to AI and have made a lot of progress in that part of the market. Can you give us a bit of an overview of the Asian market and what are some of the opportunities you're seeing and some of the risks in that part of the market?
Definitely. So, and you're right. And James mentioned in his comment earlier that the companies that have been getting the headlines in this AI era has been mostly the U.S. large mega cap companies. I think there's if you think about how the market views tech today, if you look at an index like the MSCI World IT Index, you have the US companies that are 82% of the benchmark. You have Apple, Nvidia, Microsoft, that's half the benchmark. The US is not 82% of the world's innovation, right? That's not a good representation of what the global tech industry is. In Asia, I can roughly divide it into two big categories. You have the Taiwan, Japan, and Korea markets, and these are very highly correlated to the US markets, mostly because these are enablers or the pick and shovel plays for the US customers like NVIDIA. You have I guess the headline companies are TSMC in Taiwan that manufactures 95% of the world's most advanced chips. You have Japan, which sells the equipment to TSMC, and you have the two largest memory companies in Korea, Samsung and SK Hynix, that sells high bandwidth memory to pair alongside the GPUs that NVIDIA creates to sell to the hyperscaler customers. And so those companies have performed really, really well in line with their US peers. The part that's interesting and maybe underappreciated or overlooked by the market is China. China's AI and tech ecosystem has largely been left for dead. If we had this conversation a year ago, you would see that the prevailing assumption or the prevailing view on China is that because AI is driven by compute, and because the US government has export controls on the best, latest, and greatest AI chips to China, that China would never be able to catch up in AI. And that's why US exceptionalism makes sense. But earlier this year, when our team went to China and we did on the ground research and met with the companies, we found out China was doing AI in a very different fashion from what the US was doing. And then we had the DeepSeek moment. And coincidentally, before it became mainstream, we were already discussing this internally at Fidelity. And after the DeepSeek moment, the view on China's tech and AI ecosystem has been improving and has been changing. China's doing it cost effectively. China's pursuing an open source system as opposed to the US, which ironically is OpenAI is a closed loop system. And so I think it's the opportunity set and the innovation that's coming out from China is at a very early stage, and I think it deserves more investor attention.
And if we look beyond Asia in terms of some of the other regions, are there any sort of interesting opportunities, interesting regions that you're focused on as well?
Yeah, so the one that we haven't talked about is Europe. And unfortunately, in market circles, the joke has been the US leads in AI, large language models, and Asia leads in the manufacturing, and Europe leads in regulation. But that's probably an exaggeration. There are very outstanding companies in Europe that we monitor and we look at as bellwethers. ASML will be one of them, the monopolistic company that provides lithography that has to be used to shrink transistors to make advanced chips. And you also have very innovative software companies like SAP that's already been using AI in their ERP systems in enterprises. And so those are areas that we continue to spend time on to look for opportunities. But right now, Europe's been taking a backseat to the US and Asia.
So James, as we begin to wrap up and we think about the Global Future Leaders strategy, and how do you think about the strategy in terms of a broader advisor portfolio looking to get exposure to that AI thematic?
Yeah, it's very much what Terence has alluded to. We've got enablers and facilitators are really where you can get a lot of exposure to, especially in mid caps and small caps. It is going to be a very dynamic market. Like market structures are going to change. One example of that is NRG Energy and the actually US energy space, as Maroon mentioned. The mega tech companies in the US are now signing 10-year contracts above spot price, 20, 30, 40, 50% above current spot price to lock in 10-year contracts with data centers to make sure they get the supply of power. Now that's changing the whole market structure and the return profiles of just in the power space. So that power space example extends into semiconductors, enablers, facilitators, and eventually, as I've alluded to, into software businesses as well that are going to facilitate the use of AI and the diffusion of AI into much bigger markets and into our lives and our workplaces. So yeah, that breadth and depth of opportunity set is available. It is growing, but as I said, it is dynamic and it's changing. So we need to be checking in with people like Terence every day, listening to what is actually happening because it's a very dynamic market.
Yeah, absolutely. So James, Maroon and Terence, thank you very much for your time and your insights, and thank you for the advisors that are listening. Now, just before we head off, it'd be great to get sort of one last sort of nugget of wisdom, one point you want to leave the advisors with. So maybe Maroon, with yourself, what's the one key takeout you would like advisors to take away from today?
For me, it's obviously there's a small number of large companies that have dominated the headlines, but there's a lot more happening below the surface. So definitely diversify beyond just sort of the mega cap tech names, because there's a lot of dynamic opportunities building up in the smaller mid cap space, and they will be attractive over time. So look to diversify beyond just the obvious winners today in that large cap space.
And Terence?
Yeah, I would just add on to what Maroon has said, and diversification, as we talked about in geography, there are areas outside of the U.S. that has interesting opportunities and attractive investment opportunities for us to monitor. And also, I guess beyond tech, right? We've talked a lot about tech. If history is any guide, companies or industries that are quick to adopt technology in their workflow, in their businesses, are usually the early winners within their respective subsectors. So, for example, your e-commerce companies within retail, that would be one example. So, within your industries, look for companies that are successfully adopting technology to either increase productivity or drive better customer acquisition. And those would be the winners of your industry beyond technology.
Well, thank you again, gents. And again, thank you, the advisors, for tuning in. And for more information on the topics discussed today and to access Fidelity's insights, please visit our website. Upon completion of this event, a feedback survey will appear on the screen. Please take 2 minutes to complete it, as it will help us continue to deliver timely and relevant content to you. And thank you once again for dialing in, and we look forward to connecting again soon. And once again, thank you, Maroon, James, and Terence, for the time and insights.